You're not investing in a revolutionary technology. You're investing in a narrative. This is the hard truth revealed by studying 50 years of market cycles. The gold rush was fueled by a narrative of scarcity and safety. The dot-com bubble ran on a narrative of infinite digital growth. Today, crypto and AI are powered by narratives of decentralization and super-intelligence. When the narrative becomes more powerful than the underlying asset, a bubble is forming. In this video, we'll give you a meta view of where we are now, likely near peak saturation in crypto, and what that means for your risk and exit plan. Let's start with the first modern bubble. The gold rush narrative begins with a simple promise: when money feels unsafe, gold feels safe. In the 1970s, a story about scarcity and safety took hold as inflation ran hot. Annual inflation in the US averaged around 7% for the decade, and it surged to double digits by 1979 to 1980. That meant your $100 in savings lost roughly a tenth of its buying power in a year. Groceries, gas, and mortgages got more expensive fast, and paychecks did not keep up. For investors, bank accounts and bonds often paid less than inflation, so safe assets were eroding in real terms. Gold, an ancient store of value, became the protagonist in a new story of protection when paper currencies seemed unstable. The price of gold did not just drift higher, it went parabolic. Starting near $35 per ounce in the early 1970s, it climbed past $200 by 1974, then peaked at over $800 by January 1980. That was more than a 20 times increase from the early decade. Put simply, $5,000 in gold at $40 an ounce became over $100,000 at the peak. Compared with stocks, which suffered through a brutal 1973 to 1974 bear market, and with bonds that often yielded less than inflation, gold looked unbeatable. The narrative of scarcity was amplified by financial commentators and newsletters, creating a feedback loop where buying led to more buying. What began as an inflation hedge morphed into a chase for extraordinary gains, and fear of missing out took over. At the peak, the belief hardened that gold could only go up. Headlines reflected it. Stories like "Gold Rush to Record Highs as Investors Seek Safety" and "Can Anything Stop Gold?" framed each new high as confirmation, not caution. Then the macro backdrop shifted. The Federal Reserve raised interest rates aggressively to break inflation, making alternatives like high-yield bonds more attractive. As inflation cooled, the core reason to hold gold weakened. The crash was swift. Late buyers were left with an asset priced far above its underlying reality, and losses mounted as the narrative deflated. The mini payoff here is recognizing how a compelling story can override fundamentals, especially when fear and scarcity drive behavior. The warning sign is when the story becomes the main reason to buy. Today, the same psychology shows up in your feed: virality, social proof, and crowd conviction pushing prices ahead of proof. The setting would soon shift from metal to networks, and the language of value would change just as quickly. The dot-com disruption arrived with a new promise. Online scale would dwarf anything the old economy could offer. The new story was that the internet had changed all the rules. Companies with no profits, and sometimes no actual products, saw their valuations soar into the billions of dollars. This created a new kind of gold rush, but the land being claimed was digital real estate. The focus moved away from tangible assets and toward the intangible potential of online platforms and services. Traditional financial metrics like price-to-earnings ratios were frequently dismissed as old economy thinking. In their place, new metrics gained prominence: eyeballs, meaning monthly active users or site visits; customer acquisition cost versus lifetime value; and network effects were used to justify valuations. Analysts argued that if you could capture market share first, profits would follow. Companies highlighted page views, burn rate and runway, and revenue run rates extrapolated from a single strong month. This shift in valuation language was a key indicator that the market was becoming detached from fundamental business principles. The prevailing sentiment suggested that the internet had created a new economy where conventional rules no longer applied. This era accelerated the entire market cycle. Information spread faster than ever before, and venture capital flowed more freely into unproven ideas. United States venture investment jumped from roughly $10 to $15 billion a year in the early 1990s to over $100 billion by 2000. Early investors in companies that went public often made substantial fortunes. This success created powerful social proof, drawing in a massive wave of latecomers who feared missing out on the next big opportunity. The rapid influx of capital fueled the creation of countless startups, many of which lacked viable business models and focused instead on capturing market share at any cost. The saturation point of this bubble became visible in various absurdities. Super Bowl ads became a scoreboard. Pets.com spent an estimated $1.2 million on a single 2000 Super Bowl spot, raised about $82 million in its initial public offering, and shut down within the year. Webvan burned through over $1 billion of capital before going bankrupt in 2001. Companies with minimal revenue bought primetime credibility because attention itself was treated as asset value. When the correction came, it was a reckoning for business models built on narrative alone. Firms that sold potential instead of profit saw valuations collapse. Many went bankrupt, and investors who bought the story at the top absorbed the losses. The lesson is concrete. When metrics like users, clicks, or time on site become the main reason to buy, and profits are always promised later, the bubble is inflating. That pattern matters now because the language has shifted again, and the cycle has only sped up. Crypto. The pattern on hyperdrive takes familiar incentives and runs them through a faster machine. Is crypto fundamentally different? Or is it the same story told at internet speed? The narratives are familiar. Digital scarcity replaces the physical scarcity of gold, while decentralization replaces the disruptive potential of the dot-com era. The core promises sound revolutionary, but the underlying emotional drivers are the same. The fear of missing out, and the desire for outsized returns in a changing world. The most significant difference is the compression of the cycle. What unfolded over years during the gold rush and months in the dot-com era now compresses into days. Dot-com era can now happen in weeks or even days. In January 2021, GameStop's stock jumped over 1,500% in less than 2 weeks, after coordinated posts on Reddit's r Wall Street Bets, forcing a short squeeze that sent shares from under $20 to an intraday high above $480. In crypto, Dogecoin surged roughly 600% in a week in early 2021 after a series of viral tweets from Elon Musk, and then fell more than 70% from its May peak within months. These moves were not driven by earnings or new utility. They were driven by narrative velocity. A single viral post can still be a spark. On October 26, 2021, a fake press release claiming Kroger would accept Bitcoin Cash briefly spread across social media and wire services, and the token spiked double digits in minutes before retracing when the story was debunked. Viral threads on X highlighting a new meme coin or airdrop often push prices hundreds of % within hours, only to round trip when attention fades. This hyperspeed creates an illusion of a new paradigm, masking the same underlying pattern of adoption, hype, and saturation. Meme culture and social media act as jet fuel for the narrative. The language echoes past cycles. Generational wealth, financial revolution, don't fade the community. Celebrity endorsements have become standard. Kim Kardashian's Instagram post promoting Ethereum Max led to an SEC fine and refunds. Floyd Mayweather and DJ Khaled paid penalties for touting ICOS without proper disclosures. Attention became a proxy for value. We can map the current phase by comparing narrative intensity to real utility. Stablecoin settlement and DeFi volumes exist, but for many tokens, practical use lags far behind expectations. Warning signs rhyme with history. Retail access to 50 times to 125 times leverage on platforms like Binance and Bybit. Options and perpetuals driving liquidations. And trading framed as entertainment through TikTok Alpha, Discord pump rooms, and streamer-led live trading. Search interest spikes, mainstream ad buys during major sports events, and growing retail account openings often cluster near saturation. The mini payoff here is recognizing signals that call for discipline. If the story is everywhere and the tools to overextend are one tap away, your edge is deciding how you will act before the next swing tests your plan. So here's the takeaway. Recognizing this 50-year pattern does not mean you should avoid high-growth assets. It means you need a strategy that acknowledges the cycle. The final insight is that wealth is transferred during these periods, not from early believers to latecomers, but from the undisciplined to the disciplined. In 2000, disciplined investors capped single stock exposure, trimmed into strength, and kept cash when valuations detached. They preserved capital while momentum buyers were wiped out. Define your exit framework now. Cap any single high-risk position at 2 to 5% of your portfolio. Use staggered profit-taking at preset levels. For example, sell 20% at plus 50%, another 20% at plus 100%. Set stop losses 10 to 20% below entry, and review weekly to rebalance.